Hi everyone, and welcome to the Q2 review for Fundrise. I will go over their thoughts on the recent pandemic. They talk about how the S&P 500 hit all-time highs in February and then entered a bear market at record pace. Then they go over the causes and some of the effects. Then I will go over their first half of 2020 performance. They say they are producing outstanding stability despite the volatile markets, and that's illustrated by the graph here. And then, of course, the future for investors. And lastly, I will go over my Q2 results. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying the Mercedes CLK GTR, or if you're just getting started on your financial journey, definitely like and subscribe. It had a fully removable rear body panel, sweet gull wing doors, and it also has a removable roof. If you couldn't tell, it's basically identical to a race car. It had a 7-liter V12 and 720 horsepower. Only 25 of them were made, and they currently sell for around $3 million. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. First up, to understand the current crisis, look to calamities of the past. The S&P 500 hit 6 all-time highs in February, and just 2 trading days later, on Monday the 24th, everything shifted. On that Monday, the S&P 500 fell 3.3%, and the Dow Jones fell 3.6%, along with the Nasdaq at 3.7%. All 3 markets then entered a bear market at record pace. Since the lows, the markets have rebounded, with the Nasdaq going positive on the year, and right now it is actually at record highs. However, the impact of the Rona is far from over. Investors should continue to position themselves for the future. The unpredictable nature of the Rona caught the whole world off guard. They say the previous 5 downturns were all caused by a catalyst, and this one is no different. The Rona is a prime example of a catalyst. After soaring 30% in 2019, the U.S. economy seemed strong. After news of the spread of the Rona in China, most people had no idea what was going to happen. The effects on airline, dining, hospitality, and the manufacturing industries is going to be massive. It's producing a domino effect that will hit the economy very hard. They say Boeing is a prime example of this. The most valuable industrial company in America sought a $60 billion bailout from the U.S. government due to a steep decline in air travel. This graph shows just how steep the decline is, almost a 10% overall decline in 2020 so far. Looking at the restaurant industry, it is also down very heavily. It was basically down 100% for a few months there, and now it's recovered to somewhere around minus 75%. They seem to be making a correlation between disastrous events and the Rona. In 1906, an earthquake registering 8.3 on the Richter scale tore through San Francisco. It only lasted 45 to 60 seconds, but basically the entire city was destroyed, forcing 55 to 73% of the population to be homeless. As a result of this, the markets dropped 12%, and companies like United Railway Investments saw their stock decline 30% the next day. They then say because of the San Francisco earthquake and the fact that many of the insurance policies were held overseas in Great Britain, this local problem became an international issue. As a result of this, British insurance companies paid out $46 million, and in 1906, that is a huge amount of money. In conclusion, the Panic of 1907 caused the most brutal recession until the Great Depression. The Dow Jones fell 37.7%, and this was the final straw for American regulators, leading to the creation of the Federal Reserve, creating a way to reduce the fragility of the American financial markets. While history is not a roadmap, it is a compass, and looking at history can allow you to prepare for the future. Moving on to the first half of 2020 performance analysis, Fundrise posted a 2.41% growth. The total stock market posted a minus 4.91%, and the Vanguard Real Estate ETF posted a minus 15%. So in comparison, Fundrise outperformed by about 7% to 17%. The tickers used for this comparison are VTI and VNQ. Those are both Vanguard funds. They say, looking at top-line performance, their fundamentals are strong, and they've actually seen positive rent growth in spite of the larger economic contraction. They attribute their success to a disciplined and value investment approach, as well as their active strategy of owning and lending to affordable apartment communities in growing cities. Because of the stability that they have seen in the last 6 months, they are choosing to resume normal operations, including the redemption program, as well as ramping up new acquisitions through the rest of the year. Typically, they save this level of analysis for year-end reviews, but they feel it's appropriate to do it halfway through the year for 2020. They also want to remind investors that real estate is inherently a long-term investment and should be measured in years, not months or days. Stability in the face of unprecedented volatility. Basically, Fundrise is saying they want to be a stable platform with stable growth and not display the same volatility that the market is currently demonstrating. They go on to summarize a lot of the Rona stats, like over 125,000 have lost their lives, approximately 30 million have lost their jobs. The number is down a little bit now, but it peaked around 30 million. While some of these seem like temporary trends, they can very quickly become more permanent. They say in the context of the current events, they feel encouraged by the strength of their overall portfolio, especially in comparison to the equity markets. The stress test they did in April gave them a high degree of confidence, but there's nothing more reassuring than seeing the actual performance. Again, they reiterate the 2.41% growth in comparison to the negative returns from the Vanguard ETFs. They say that while performance is good, it is not the only measure of performance. The fact that the Dow Jones plunged 37% in March, then recovered 48% to its peak in June, still being down almost 10% compared to the consistent growth of Fundrise, is another measure that they use to demonstrate their success. This chart demonstrates the numbers that were stated before. You can see here the markets were doing well, outperforming Fundrise. And then we had the Rona where the markets tanked, but Fundrise maintained its value and continued to pay dividends throughout this period. And even during that, the markets still have not recovered to the point where they could match Fundrise's value. They say while investors are told not to react to large market swings, we are still human beings and we have our finger on the sell button, sometimes locking in double-digit losses. They're using this to support their case that Fundrise's stability is part of its overall methodology of delivering gains to investors. They say comparing Fundrise to public markets is like selling a commercial building at a 30 to 40% discount just because you need to find a buyer at the time. This would be like sitting through the stock market drop and then selling right at the bottom prior to the gains. It's difficult for human nature to sit through that kind of a loss without feeling uncomfortable or selling out, which is one of the strengths of Fundrise. They say that they chose to suspend the redemptions program, ensuring that the company had enough cash on hand to maintain all of its assets, and they want to remind investors that they were never at risk of selling any assets. In addition to that, they did choose to reduce their dividends over second quarter, and this gives specific properties that they own more flexibility in terms of cash to help support their customers. Looking at their equity investment portfolio, you can see that almost 90% of their assets decreased in value less than 5%, right around 10% decreased between 5 and 10%, and nothing lost more than 10% of its value. You can see here the current breakdown of all of their investments. They have almost $500 million in total investments, and the majority of that is in stabilized apartments. They say that everything that they've invested in over the past 4 years has shown itself to be beneficial. They've improved in both occupancy and rental incomes, and they have maintained themselves across the portfolio. You can see here their occupancy rates have been stable year over year. Their delinquency rates went up a little bit, but their rental income also increased. They say that apartment assets have performed exceptionally well, and they even outperformed the industry average. They say that their apartments are concentrated in high-end areas like New York, Chicago, Boston, and San Francisco, and they say that they have focused on reasonably priced apartments within these high-growth cities. They say despite the fact that young workers are decamping from these high-density cities, like minus 5.7% in San Francisco and minus 3.6% in Boston, they still see rental growth across their portfolio. In terms of their fixed income investments, almost 97% of them are in good standing, 2.7% are in default, but they expect to recover the principal, and only 0.5% are in default with principal at risk. You can see the breakdown here, around $435 million. This amount is a little bit less than the equity investments. They say preferred equity investments make up 25% of their overall portfolio. They say that these debt structure-like investments generally produce 15 to 25% over common equity, and they are contractually required to receive between 9 and 12% interest rates. They say that this ability to receive relatively high returns with relatively low risk has not gone unnoticed and has become the darling of institutional investors. Looking at their portfolio holistically, they say less than 4% of their overall portfolio have seen a material decline, which is defined as more than 5%, and this is primarily in hotel assets, which are currently located in primarily hospitality-driven areas. If you've been paying attention to the economy, hospitality has been one of the hardest hit industries, and Fundrise still feels confident that in the long term, this will be a profitable investment. They say they enjoy investing in a world without downturns, but they understand that this is unrealistic, and they strive to make their portfolio function as a resilient and self-sufficient ecosystem. Again, compared to VTI and VNQ, Fundrise has outperformed both of them. Moving on to their future plans, they say while some of the worst possible outcomes have been avoided, they still believe that the near-term effects of all the stimulus measures have been to calm the markets and reduce fear of a lack of liquidity. They say that they have not had to draw on their cash reserves, and in some cases they've seen positive growth, as well as a continued inflow from their investor base. They continue to err on the side of caution in order to prevent the loss of any properties. They conclude with a quote from Warren Buffett, "Take care of the downside and the upside will take care of itself." Moving on to my current portfolio, you can see I'm just over $24,322. Year to date, I've made $422, and all time I've made $971. My goal is to get this account to $750,000 by May 2040. And to aid in your progress, it helps keep track of how much you need to invest each month. So before July 31st, I need to invest $216 to stay on track with my goals. You can see here this quarter I received $22.97 in dividends. And up here it shows that if your friends sign up with your invitation, which I will put in the description, they will get their fees waived for the first 90 days. And finally, getting to my second quarter snapshot, I received $318.95 in total returns. This includes equity returns as well as dividends, and I invested $1,700. And I also paid $6.49 in advisory fees. I've been invested with Fundrise for just over 4 quarters now, and you can see here how my account has performed. So to summarize, they are treating the Rona like the earthquake of 1907, which means they were exercising caution to maintain the stability of the company. They have significantly outperformed the public REIT market and even the total stock market, and they did so while maintaining stability and their value. And because of the excellent stewardship of Fundrise, I was able to make $318, which works out to be 5.7% when converted to an annualized rate, while the total stock market is still down. If you're interested in using Fundrise as an investment tool, make sure you use the link in the description to get your first 90 days of fees waived. If you have a Fundrise account, let me know in the comments section how your account performed. Definitely like and subscribe if you got any value out of this video. Of course, this is not financial advice. This is all for entertainment purposes. And with that, let's get to the jelly. If you've watched my channel at all, you would know that I am a big fan of Buff Carell, and this week's jelly is another wonderful song from him. So here's what that sounds like.
What's up, it's your boy Buff Carell, baby, back up with that level, trying to get down. It's your boy once again. Tell a friend on the levels, righty, roo, righty, roo. Ready, roo, righty, roo. What can you do when you're righty, roo? What is love? Baby, don't hurt me. Don't hurt me no more. Baby, don't hurt me. Don't hurt me Why you not there? I give you my love, but you don't care. So what is right? What is wrong? Give me a sign. What is love? Baby, don't hurt me. Don't hurt me no more. What is love? Baby, don't hurt me. Don't hurt me no more. Whoa.
While Buff Carell may not be the best singer, he sure sings with a lot of heart. Anyway, I think he's hilarious. He's got millions of views, hundreds of thousands of followers, and I appreciate his rendition of What Is Love. Let me know down in the comment section what you thought of his song. If you want to watch the rest of the video, it is linked in the description. Definitely like and subscribe if you got any value out of this video, and have a great day.